Welcome to the Deep Dive. Today we are cutting straight through the year-end noise with a hard look at the financial report from December 28th, 2025.
And we have to. The market is showing a kind of split personality right now that needs unpacking.
That's the mission, right? To understand how we can have stock indices near record highs, all this AI optimism, while another part of the market is signaling extreme fear.
It's the defining contradiction of late 2025. The numbers just don't seem to line up. So for you, the learner, we need to dig into why these two stories are happening at the same time.
Okay, let's start at the foundation then, the macro environment. What are interest rates telling us?
Well, rates show a market that's looking really far ahead. We have the 10-year Treasury yield at about 4.14%.
And the 2-year is lower.
Right, at 3.46%. So the spread is positive, which is good. But the real story is that the market is already pricing in rate cuts. Heavily.
For when?
Starting in the second half of 2026. That expectation is already baked in.
So the market believes the Fed is done. But does the current data support that? Let's look at inflation.
That's the million-dollar question. The U.S. CPI for November was around 2.7% annually. Core was a bit lower at 2.6.
It's not terrible. It's in the ballpark.
It's in the comfort zone, but it's sticky. And there's always the risk of a rebound next year, policy shifts, tariffs.
Yeah.
It's still hanging over everything.
And the jobs picture seems to reflect a slowdown.
It definitely does. The labor market is cooling. November's non-farm gain was only, plus 64,000?
That's a big drop.
It's a major deceleration. And the unemployment rate has crept up to 4.6%. So, yeah, the engine is cooling.
Okay, what about liquidity? We saw a specific number on the Fed's reverse repo program.
Right, the RRP, it's back to about $20.34 billion. Now, for you listening, that's just the place where money market funds park cash overnight.
And that number is way down from its peak.
Drastically lower. We were seeing peaks in the trillions not long ago. So this tells us that either liquidity is contracting or it's finding riskier places to go. The system is tighter than people think.
So we've got a cooling economy, tighter liquidity, and yet the VIX, the stock market's fear gauge, is at 13.6, basically asleep.
Exactly, and this is where the narrative just blows apart. A low VIX is pretty typical for year-end low-volume trading.
A false sense of security.
It can be, because you pivot to crypto, which is a pure barometer of risk appetite.
And it's the total opposite?
It's an extreme fear. The index is sitting between 20 and 25. So you have to ask yourself, which market is telling the truth about global risk?
That's the perfect setup. Let's follow the money then, starting with the optimism, equities.
It's almost entirely an AI story. You look at broad ETFs like VOO and QQQM, they're just ignoring the macro data.
Hovering near record highs.
Yep, VOO around 634, QQQM at 256. It just shows the market will pay any premium for growth as long as it has that AI label on it.
And that means NVIDIA.
Of course. NVDA is trading around 188 to 190. And it's being fueled by really specific news, like a rumor about a deal with Grok. It's that reactive.
We also saw a circle in the report, the USDC issuer. That feels important.
It's critical. CRCL, post-IPO, is trading around $80 to $83. And the reason for the attention is all about its regulatory implications.
Meaning it's a bridge between traditional finance and crypto.
Exactly. Its IPO price validates the institutional appetite for stablecoin infrastructure. It's almost like a bet that stablecoins get fully integrated into the system.
Okay, so that's the optimism trade. Concentrated, tech-focused. Let's flip to the fear trade. Precious metals are on a tear.
On a tear is an understatement. Silver has hit new historic highs, trading around $78 to $79 an ounce.
Wow, and gold.
A new record, too. $45.34 per ounce.
What's behind the silver surge specifically? It's not just an inflation hedge, is it?
No, it's a powerful combination of factors. Yes, it's a hedge against a weak dollar, that's traditional, but silver has huge industrial demand.
Solar panels, electronics.
All of it. And that demand is hitting incredible supply shortages. So when you see silver break out like this, it's a signal of systemic anxiety about inflation and the supply chain.
Which contrasts completely with oil prices, which are soft, around $56 a barrel.
And that split is very unusual. Soft oil reflects slowing global growth. Record metals reflect high anxiety. It's a very messy, divided picture.
Which brings us to crypto, the home of extreme fear. Bitcoin is consolidating.
The price is, BTC is in that $87,000 to $89,000 range, ETH around 2.9K, but the sentiment is just terrible.
So why is the Bitcoin to gold ratio still so high at over 19?
And that is the paradox. The ratio shows that over the long term, investors still value Bitcoin significantly higher relative to gold.
So short-term fear, long-term conviction.
That's it, exactly. The fear and greed index is reactive. The ratio is structural. It tells you to be patient, not to panic sell.
Let's touch on the most speculative corner, pre-stocks. What are we seeing with names like OpenAI and Anthropic?
Well, these are just shares of private, pre-IPO companies traded on secondary markets.
And the valuations are huge.
Enormous. OpenAI is trading around $1,000 a share. It just shows the desperate scramble for any exposure to the big AI players. It's maximum greed.
Okay, let's tie it all together. AI optimism versus extreme fear. What's the one factor connecting them?
It's the US dollar index, the DXY. It's weak, around 98, and it's heading for its worst year since 2003.
And a weak dollar fuels both sides.
Precisely. A weak dollar makes dollar-denominated assets like gold and silver more attractive. That's your fear trade.
And at the same time,
global capital flees that weak dollar looking for growth, and it all rushes into the one story that promises that: AI stocks.
So given the split, what's an actionable strategy for 2026?
You have to be balanced. For equities, with high valuations, you do phased, defensive buying of the quality leaders. Think NVDA, GOO, Meta.
Wait for pullbacks.
Yes. For metals, you increase your allocation for hedging. Gold for safety, silver for a bit more speculative upside on that industrial demand story.
And crypto.
Patience. Absolute patience while extreme fear is on the board. Maybe set some buy points to reevaluate if BTC gets near 80K.
And pre-stocks are obviously a high-risk game.
Extremely high risk. Small positions only. And don't forget bonds. If you believe rate cuts are coming in 26, you should be looking at a laddered duration strategy.
A clear roadmap. So as we head into the new year, we're watching liquidity, the yield curve, and any macro policy shifts.
That's what matters now.
And this all leaves you with a final provocative thought. How long can this AI-driven optimism keep stocks near record highs when a huge part of the global risk market remains in a state of extreme fear? The market is making a choice between two futures. Your strategy needs to be ready for either one.